Owners at Capital Tool Machining don't dream about income statements. They dream about growth, but many hit a wall when the bank says no. You're busy, you're real, and you have clean CPA statements. So why is financing so hard to reach? The answer is the overhead allocation illusion. In your standard CPA statement, you show a 40% gross margin. On paper, it looks powerful. It implies your shop is strong and the problem is just overhead. But lenders don't fund grind. They fund repayable cash flow. They want to know the true cost of producing every dollar of revenue. If 90% of your building is the shop floor, rent isn't overhead. It's a production cost. The same goes for your heavy machine power draw. When we reclassify these costs, your 40% margin moves to 15.4%. This isn't a new expense, it's just putting the truth where it belongs. This shift changes the conversation. Now a bank can see your true unit economics and how much margin is actually available to service debt. The bank isn't ignoring your statements, they're translating them. They need to know if you have a durable engine or a thin margin treadmill. If Capital Tool Machining is serious about growth, stop walking into financing meetings with statements that make the lender guess. Get professional assistance to produce a bank-ready, investor-ready package, plus the allocation schedules and management adjustments that show true unit economics. When the story is properly presented, lenders move from uncertain risk to understandable risk, and understandable risk gets funded. Call a SaferWealth advisor to help de-risk your presentation. SaferWealth.com, presenting reality.